Good morning and welcome to the Saxo Bank Morning Call. It is FOMC Day, Wednesday, June 19th, 2019. And I think markets obviously looking at this event with considerable anticipation. And we have some new plot twists, certainly for the markets ahead of this event yesterday. A couple things happening. The biggest one, of course, in case you're living under a rock, was the fact that Trump announces that he will have a quote-unquote extensive meeting with Xi of China at the G20 meeting. This really putting stocks on the bid. Again, we have a chart here of the NASDAQ 100 for a sense of the scale here, where the rally has already been in place on anticipation of a considerable easing message from the Fed. So that extension higher there, and it's quite incredible. Now we're within 1% or so, maybe 2%, depending on the index, of those all-time highs. That red line was the previous all-time highs that were briefly breached back in April and into early May. So let's look at another thing that happened yesterday, and that was Draghi out speaking at this ECB forum in Portugal. I tweeted out an interesting article that suggested his remarks may not be shared by all the ECB Governing Council. Regardless, the market took Draghi at his word as he promised essentially new easing, claimed that there's plenty of headroom for QE, etc. And if we look at Bloomberg's world interest rate probability chart, we can see here that the market is actually pricing for more easing from the ECB. Look at, for example, the December meeting there, the fourth line on the table, and you can see that the market is pricing at least 10 basis points of easing, and some even looking for a policy rate of minus 60 basis points, etc. Quite incredible that Draghi willing to send this message. It seems to me all about the ECB needing to send the message that it really can't do much more if the Eurozone or if the European Union wants its economy to get it jump started from here. It's going to need to look at something like fiscal stimulus, which then the ECB could be happy to help cover the costs of via printing money. I also on my table here I showed at the bottom that Donald Trump took the opportunity, President Trump, to point out that Draghi had announced that stimulus, and he says it immediately dropped the euro against the dollar, making it unfairly easy for them to compete against the USA. So basically, Trump, the trade warrior, very cognizant of what's going on, and this is an indirect message to Powell as well. If you didn't get a chance to see it already, just have a FOMC preview video. It's already suddenly a little bit out of date because of the development on the trade fronts, but I think there's still some great perspective on the historical situations where we've seen the Fed switching into easing mode. I go over the last 3 times this has happened. This is only the 4th time again in over 20 years that we're seeing the Fed switching from tightening to an easing mode. 1998 was the first time, 2001 and 2007. So I think some interesting scenarios in there and some thoughts on what this could mean for various instruments. I think today, though, we do our last minute sort of rundown of what is the most likely scenario. This is, we have to work in probabilities, so this to me is somewhere in the middle of the probabilities, and we could certainly be surprised in either direction. But this is my assessment of what the Fed is likely to do here. Generally looking to avoid surprises, I think, is the main message. Obviously, they want to open for a July move. The Fed has a history of not wanting to surprise the market. So if it's allowed the market to so aggressively price that July move at 80% plus probability, I don't think it's going to want to push back against that. However, I think they may surprise in terms of not being willing or to commit to what the market's begun to price in beyond that. So let's go back to our list of bullet points here. They really have to remove this patient word. If they're going to cut rates in July, why do you maintain a patient stance? So that'll be interesting. Of course, if it's kept, that looks hawkish. Dot plot adjustments here, I think where there's the difficulty in adjusting as much as the market has, because they have to look at beyond this next meeting or two to where they think the rate will be over the next year, 2 years, etc. And this is where I have a difficult time seeing them fully adjust. There could be a lot of dispersion in the results, more wider variety of opinions, but that's an interesting one to watch for a potential hawkish surprise. And then a whole laundry list. We're watching this, that, and the other. Of course, incoming data. I wrote data there. I meant data. The trade situation, which of course has suddenly improved. At least expectations have improved as of yesterday's announcement of that meeting. And then if they mention the dollar, I think this is another word or another angle here we need to look at. Important whether the Fed is starting to bring up and promote the dollar as a factor in its policy setting regime. And then at the bottom there, I say, well, what is the most likely reaction from the markets? If we get something more along more or less along these lines, it just seems to me that the market doesn't have a lot to go on other than the fact that it's built up so much anticipation that we could see a sell the fact type of reaction. What are we selling? Equity markets, perhaps, maybe at least some consolidation. Maybe they don't feel like the Fed is delivering enough. A lot of the upside feels like it's been driven by extreme anticipation of rate cuts in the coming meetings. Maybe a modest sell-off there. I think the bigger one to me, the more extreme move has been in U.S. Treasuries, and that's where I see the potential for some consolidation, some sell the fact type of reaction, unless the Fed really surprises on the dovish side of things. Dollar firmer, perhaps, I think is a potential reaction here. I think the pattern of where it's firmer could be interesting. If we have a bit of risk off, then it could be a bit firmer against emerging markets, against the commodity dollars, etc. And then on the other side, maybe not so much interesting activity again in dollar yen and euro dollar. Although if U.S. Treasury yields are rising again, I would expect dollar yen at least not to fall, even if there's a bit of risk off over this meeting. And the final point is that the sudden hope about a Xi-Trump meeting does kind of change the equation. I think it reduces the sense of confidence on the reaction function here to the FOMC statement. A couple supporting slides. Again, I put this one out yesterday. It's just showing the red line for that 2020, where the market is priced 2020, around the 1.5% level for a Fed policy rate then. You can see how far away the last dot plot was from that level in March. So just keep an eye on that. Again, I have a hard time seeing the adjustment being so radical, but maybe enough dispersion there for the Fed to more or less match that forecast. But interesting one there. As well, again, the Fed's measure of the dollar suggests that from the Fed's point of view in trade-weighted terms, the U.S. dollar is close to those highs from 2002. And I think is a background factor that is going to continue to see the Fed at least cautious and maybe inclined to consider rate cuts as long as there's not very direct signs of aggressive growth coming back online in the U.S. A chart on Treasuries, I have those here. This is the 10-year. You can see we've seen a little bit of reluctance to go higher here. Part of that, I think, is the 10-year benchmark nearing the 2% level. It traded as low as 2.015% yesterday, right around the time that Trump announced or tweeted out this meeting with Xi to take place. That was the top in the Treasuries or the bottom in yields, and I think that's an interesting level, 2%. These big round yield levels are interesting. Also, you can see a bit of divergent momentum on the bottom there, the MACD. So potentially rolling over here again if the Fed under-delivers a bit, and we see a bit of we can see a bit of consolidation. Treasuries. Been a very extreme move over the last couple of months. And on that note, if U.S. yields are consolidating, we could be seeing some consolidation in yen crosses. Look at the slide here in Aussie yen. Maybe not so much in Aussie yen, could also be in dollar yen. Depends on the focus here in terms of the mix of if yields are rising again and risk appetite is consolidating. If risk appetite heads higher again and we have yields rising, I think that's the most potent combination for something like Aussie yen. And then gold. We talked a lot about gold. If the Fed under-delivers a bit, it may be a little bit premature to expect gold to do this massive breakout of the 1350 to 1375 level. Of course, we'll keep an eye on it and we'll respect the technical signals. I have the chart here once again. And once again, yesterday we saw it rising above 1350, and then the Trump announcement of the meeting punches it back below. A very nervous market there. And you can see there's potentially a link to U.S. Treasuries if we look at the correlations there. So this is the U.S. 10-year yield in blue, and I've inverted that. So as yields fall, the blue line goes up. And you can see the most accelerated phase of that coincided in the very beginning of June and late May with the big rise in gold prices. So an interesting potential correlation there, and it's something that will be tested over today's FOMC meeting. Let's get to our chart. I mean, it's all about the FOMC, but let's get to our calendar of upcoming events. We have a couple of things to distract us. Some Swedish data. UK CPI could move things at the margin. Canadian CPI as well actually could move things quite a bit for the CAD. Draghi out with some closing remarks. Keep an eye on that, obviously, and then the FOMC meeting itself and the Powell press conference. Very, very, very pivotal stuff for the general message and how the Fed is going to deal with such tremendous expectations built into the market for a Fed policy shift here. How does he deal with that after the very awkward communication pivot or policy pivot from the December rate hike, which many have seen as a bridge too far or a hike too far, and then the pivot to a dovish stance and unwinding QT. That's a mouthful. That'll do it for today. And of course, stay on your toes and be aware of your risk exposure over this FOMC meeting tonight. A big surprise either way could certainly spark considerable volatility in just about any asset class. This is the world central banker. We do have a lot of anticipation coming into this meeting, so a risk warning there for traders out there. Thanks for joining today. We'll be back tomorrow with the Saxo Bank Morning Call.